Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aramark quarterly report. Aramark provides a wide range of services to various clients across the globe. The company operates in two main segments: Food and Support Services United States and Food and Support Services International. In these segments, Aramark offers numerous businesses and services that cater to different needs. The company's food-related managed services include dining, catering, food service management, and convenience-oriented retail services. Additionally, it provides non-clinical food and food-related support services such as patient food and nutrition, retail food, environmental services, and procurement services. Aramark also offers plant operations and maintenance services, including custodial/housekeeping, energy management, groundskeeping, and capital project management. Furthermore, the company provides on-site restaurants, catering, convenience stores, and executive dining services. It also offers beverage and vending services, as well as facility management services that include landscaping, transportation, capital program management, payment services, and other consulting services related to building operations. Aramark services extend to concessions, banquet and catering services, retail services and merchandise sale, recreational and lodging services, and facility management at sports, entertainment, and recreational facilities. In the correctional sector, the company offers food services and operates commissaries, laundry facilities, and property rooms. Overall, Aramark provides a comprehensive range of businesses and services that cater to various industries and clients worldwide. Aramark's stock price has experienced fluctuations over the past year, with varying reports of its one-year return ranging from a decrease of 1.69% to an increase of 4.5%. Despite these mixed results, several positive news events and strong financial performances have contributed to periods of stock appreciation. One significant factor was Aramark's fiscal year 2026 earnings announcement, which saw the company's shares surge by 4.05% in midday trading. The report revealed better-than-expected revenue growth, record client retention, and major new contract wins, including its largest U.S. contract ever with Penn Medicine. Additionally, Aramark's Q2 fiscal year 2025 earnings showed a 2% increase in consolidated revenue, with organic revenue growth of 3%. Operating income rose by 9%, and adjusted operating income increased by 11%. The company also maintained high client retention levels and enhanced its financial flexibility through debt repayment and refinancing initiatives. Furthermore, Aramark's fiscal year 2025 earnings reported a 3% increase in revenue, 5% organic growth, and a significant increase in GAAP EPS. The company initiated share repurchases as part of a $500 million program, signaling confidence in the business. These positive events have contributed to periods of stock price appreciation for Aramark, but did not result in an overall increase of a little over 9.06% for the entire past year. Aramark market capitalization of $11 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Aramark holds a significant advantage in their industry. Aramark trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 3.36 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 76% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. On the growth side, sales expansion in food and support services contracts, successful integration of acquired businesses, and base business growth in key sectors such as business and industry, healthcare and facilities, and other have contributed to a 17.4% increase in revenue. Additionally, favorable foreign currency translation has added 4.1% to the revenue. On the other hand, revenue decline can be attributed to several factors, including failure to retain clients, increased costs of services provided, depreciation and amortization, and selling and general corporate expenses. Furthermore, a reduced number of operational service days in the education sector, due to calendar shift, has also led to a 4.8% decline in revenue. It is worth noting that foreign currency translation adjustments have had both positive and negative impacts on revenue, resulting in a net neutral effect. Overall, the growth drivers are largely driven by organic expansion and successful integration of acquired businesses, while the decline factors are primarily related to operational inefficiencies and increased costs. Net income and profit margins. A changing landscape, the net income of the company underwent significant fluctuations over different periods. Initially, it decreased by $9,202,000, representing an 8.7% decline from $105,703,000 to $96,501,000. However, in another period, there was a notable increase of 200%, rising from $105,619 to $315,470. Unfortunately, this growth was short-lived, as the net income decreased by an estimated $25 million due to reduced operational service days. The profit margins also experienced changes during these periods. The operating income margin remained relatively stable at approximately 4.5%. However, the net income margin saw a decline from 2.32% to 2.13%, indicating a decrease in profitability. In other periods, the company's profit margins decreased further, although specific percentages are not provided. The reasons behind these changes were multifaceted. Foreign currency translation adjustments and fair value of cash flow hedges had an impact on net income. Additionally, personnel costs as a percentage of revenue increased, along with other direct costs, depreciation and amortization expenses, selling and general corporate expenses, and interest expense net. These factors collectively contributed to the fluctuations in net income and profit margins. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has successfully produced a substantial amount of positive operating cash flow. This is evident from the fact that it generated $1,234,119 of positive operating cash flow for the period ended January 2, 2026. This achievement is a testament to the company's effective management and operational efficiency. The ability to generate positive operating cash flow indicates that the company is able to cover its expenses and invest in growth initiatives without relying on external financing. This is a crucial aspect of any business, as it allows for sustainable growth and development over time. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt has increased from $5,374,394 to $6,210,899, indicating a rise of approximately $836,505. Additionally, the fair value of debt at January 2, 2026 was $6,296.2 million, up from $5,445.7 million in October 2025. In terms of interest expenses, there has been a notable increase. The interest expense for January 2, 2026 was $70,035 compared to $65,261 in December 2024, representing an increase of $4,774. Furthermore, the net interest expense for 2026 was $81.9 million, which is down from the previous year. However, it's worth noting that the interest expense, net, increased by $6.1 million. The overall trend suggests a rise in debt level and interest expenses, with some fluctuations in between. The company's financial situation appears to be undergoing changes, which may have implications for its future performance. The performance of various segments and regions within the company has been mixed. On a positive note, FSS United States demonstrated strong results with significant revenue and adjusted operating income growth. The business and industry segment also showed impressive growth at 18.1%, while healthcare and facilities and other segments experienced moderate growth of 4.1% and 2.7%, respectively. The FSS International segment, although relatively weak compared to its U.S. counterpart, still managed a notable revenue increase of 17.4%. This growth was driven by several countries, including the UK, Chile, Germany, and Spain. In contrast, the education segment struggled with a decline in revenue of 4.8%, while the sports, leisure, and corrections segment faced low single-digit adjusted operating income margins. Overall, these results highlight areas where the company excelled and those that require improvement. The strong performance of FSS United States and certain international segments provides a solid foundation for future growth, but the underperforming education and sports, leisure, and corrections segments demand attention to address their challenges. Management's outlook on the company's strategy is one of optimism and confidence. They expect a favorable federal cash tax impact from the OBBB Act, which will not significantly affect their effective tax rate. This suggests that the company is poised for growth without major financial burdens. The management team has also demonstrated its commitment to returning value to shareholders through a share repurchase program of up to $500 million. Additionally, they intend to continue paying cash dividends on common stock, although future payments will be subject to the discretion of the board of directors. Furthermore, management is taking proactive steps to mitigate risks such as foreign currency volatility and fluctuating trends in global inflationary costs and market interest rates. By managing operating costs and interest rate risk, the company is positioning itself for long-term success despite potential economic uncertainties. Overall, management's strategy appears focused on growth, shareholder value creation, and risk mitigation. Their confidence in the company's financial position and ability to navigate challenges suggests a strong foundation for future performance. The company has made several significant transactions during the period. In terms of acquisitions, there is limited information available. However, it can be inferred that at least one acquisition occurred, as evidenced by the $6.8 million amortization expense related to intangible assets on page 25. Unfortunately, no specific details are provided regarding this or any other acquisitions mentioned in page 27. On the other hand, there is more clarity surrounding divestitures. The company has spun off Aramark Uniform and Career Apparel as an independent publicly traded company to its stockholders, as stated on page 1. Additionally, a business is being held for sale, although no further details are provided in page 27. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid out a total of $27.9 million in fiscal 2025, with an additional payment of $31,537 made on January 2, 2026. This demonstrates the company's commitment to rewarding its investors. In addition to paying dividends, the company has also been active in buying back shares. In fact, it has made several significant purchases, including a payment of $41,262 on January 2, 2026. These share buybacks are likely intended to reduce the number of outstanding shares and increase earnings per share for existing shareholders. Overall, the company's actions suggest a focus on creating value for its investors through both dividend payments and strategic capital allocation. That concludes the financial summary for Aramark. Feel free to comment below, and I will be happy to answer them when possible.